Hi, everyone. My name is Kate Lanier. I am the lead of ACT, the App Association's Amplify Diverse Talent Working Group, and I'm excited to be with y'all for our panel, Access to Capital, the Issues. And this is part one of a two-part webinar series where we're going to be discussing access to capital and the slew of issues that Black, Brown, Indigenous, and people of color face when trying to start a business. But before we get into the panel, we're going to kick off with some opening remarks from U.S. Representative Sharice Davids. Bear with me while I screen share. I know we've been in the pandemic for a year plus, but for some reason, screen sharing is still intimidating to me. So give me a second here. All right, wonderful. I'm going to go ahead and press play.
Hi, everyone. My name is Sharice Davids, and I'm the representative for Kansas's 3rd Congressional District. Thank you for having me here today to join your series on access to capital and to talk about what is a really important issue. You know, in my first term when committee assignments were being decided, I was thinking a lot about where I felt like I could actually make an impact as a legislator. And I was excited to join the Small Business Committee, which covers so many issues relating to entrepreneurs, small and medium-sized manufacturers, SBA programs, and of course, Main Street businesses that generally make our economy run. I felt like this was a perfect place to both tackle the big issues in our economy and make an impact on the everyday lives of Americans. I have been an entrepreneur myself. My district is a hub of small business activity, so I know the struggle and the successes that so many folks face in pursuing their dreams. And, you know, I spent some time working in economic development in Native American communities prior to my time in Congress. And I know that it can be really difficult for underserved and underbanked communities to grow an economy. And, you know, my approach as a lawmaker has really focused on using those experiences to help advocate for folks whose voices are not often listened to. And you know, throughout my time on the committee, I've worked on legislation that has directed the Small Business Administration to increase outreach to veteran entrepreneurs, and legislation that's increased the accreditation standards for women's business centers. I've participated in hearings that have examined the issues leading to unequal access to capital and have investigated the opportunities and the challenges that are faced by minority small business owners. Now, as the chair of the subcommittee on economic growth, tax, and capital access, I get the chance to explore these issues more deeply. So far, I've had the chance to chair 2 hearings with the subcommittee. The first was focused on empowering small manufacturers who had to pivot to help us with the pandemic and making medical supplies. And then just last week, I had the chance to hear from community development financial institutions and minority deposit institutions, or CDFIs and MDIs, as you probably know them. That hearing was particularly insightful because of the unprecedented year that we've had. And with all the new policies and issues that lenders are facing during the pandemic, it's that much more important. You know, we got to hear about the persistent and unequal access to capital that minority business owners are facing. You know, our current credit scoring model has put too much pressure on otherwise credit-worthy folks, people of color, you know, folks who are consistently denied conventional lending, and it's making it harder to build credit and wealth. And then on the business side, we see Black and Brown entrepreneurs are being denied loans at nearly twice the rate of their white counterparts. Women and people of color often receive higher interest rates and terms that are less favorable. And we know that the pandemic only exacerbated those issues. In 2020, Black, Latino, and Asian Americans experienced drops in business ownership rates that were much higher than their white peers. These same groups also had less access to some of the federal relief programs like the Paycheck Protection Program, because they didn't have the same access to bank accounts. These realities have driven economic opportunity out of the reach of so many people. And the work that we do in Congress has to be aimed at leveling the playing field and focusing on the problems and proposing solutions. For example, things like the PPP, when that was springing into action, my colleagues and I on the Small Business Committee worked to make sure that CDFIs and MDIs were able to really access those programs so that their clients could access those programs. We passed legislation to make sure that the Paycheck Protection Program gave equal footing to so many of the folks who are often left out of these systems. During the COVID-19 pandemic, we know that small businesses reported the greatest level of satisfaction with CDFIs and small and medium-sized community banks, which demonstrates to us that CDFIs have an effectiveness level of reaching communities that are often left out. We saw higher percentages of loans that were less than $150,000, more loans made to rural areas. And those efforts are what is really important for us to focus on and make sure that we lift those up. I want to talk a little bit about the SERVE Act and the Women's Business Center Improvement Act. When it comes to communities that are traditionally shut out of the entrepreneurial world, and in the case of those businesses, we're talking about veterans and women where the resources just are not there. And we have to make sure that we're getting that information out there, that folks know that those resources exist, and then that they're able to access those resources, because the challenges that are facing Black and Brown, Indigenous, and underserved entrepreneurs are unique. And we have to make sure that those solutions really address the unique issues, because obviously the issue is not a lack of ambition or talent or drive. Those things all exist. And the work that you all are doing by having these conversations is the way that we address and make sure that we don't continue that. We have to make sure that every entrepreneur with a dream and a plan, no matter who they are or where they come from, has access to the resources to help them thrive. And I'm so honored and appreciative of you all inviting me to speak with you, to share a little bit about the work that I've been able to do, because it's our collective work that's going to help us get to a thriving economy that is inclusive of everybody and supportive of everybody who is ready to solve a problem and be the entrepreneur that we know we have all benefited from. So thank you again for inviting me to speak with you all today. And I look forward to hopefully seeing you in person soon.
Awesome. And we want to thank Representative Sharice Davis and her staff for lending their expertise to this event. Next, we're going to be hearing from ACT, the App Association's Executive Director, Chelsea Thomas, for a little bit more information on our Amplified Diverse Talent Working Group. And I'll be screen sharing again in the wrong way. Hopefully the right way, though.
Diversity, equity, and inclusion. These pillars are more than just a trending topic or a performative corporate commitment. They're what build us up and make us stronger. I'm Chelsea Thomas, and I'm the Executive Director of ACT, the App Association, and I'm excited to roll out our Amplified Diverse Talent Working Group. We recognize the gap in representation and the inequities in our industry, and we want to help change that. Like our Amplify blog series, our Amplify Diverse Talent Group is working for empowerment in the app economy. To do this, we plan to elevate diverse persons in the app economy. Whether it's through congressional testimony or speaking engagements, blog posts, or Twitter threads, we're all hands on deck to lift voices and stories to allow everyone an equitable opportunity. And yes, this starts with us making the same commitment to keep our events more diverse and inclusive. We also recognize that it can't be only up to those voices that we seek to amplify to do the work to educate. We shouldn't expect those who are harmed by an inequitable system to point out the problems, propose solutions, and facilitate dialogue, education, and change. The time has come for others to commit to the same work, and we are eager to play our part. Our working group aims to be part of the solution and help advocate for policies that increase opportunities rather than perpetuate injustice, and to do so mindfully with a strength-based approach. Whether you're a woman, a person of color, a member of the LGBTQIA+ community, or someone who feels marginalized based on different mental or physical ability, we see you, we recognize you, and we want to amplify you. Let's get to work.
And with that, we're going to jump into the details. So the racial wealth gap in America has remained relatively unchanged since 1967, with Black and Brown Americans making a little more than $57 for every $100 in income earned by their white counterparts. When you consider that 60% of new entrepreneurs use personal savings to start a business, that statistic becomes even more alarming. And to make matters worse, Black and Brown entrepreneurs are denied loans at twice the rate of their white counterparts. And BIPOC entrepreneurs receive only about 2.6% of VC funding. These statistics are an economic reality of millions of Americans and are a key factor in driving economic opportunity out of reach for many people of color. So today we're here to discuss those issues, and I'm going to allow the panelists to introduce themselves and give a little context for why they're here to chat today. So Dr. Charles Corporal, we'll go ahead and start with you, and then Stephen and Gino.
Caitlin, thank you for putting this together. We are tremendously grateful for the opportunity to speak with you and your colleagues. As you mentioned, my name is Dr. Charles Corporal. I am the senior lead of our Camelback network at Camelback Ventures. We are an organization built by Aaron Walker that is 6.5, almost 7 years old, where we believe that genius is representative, but opportunity is not. And so we make sure that we have the ability to basically pour into BIPOC founders and women, giving them the opportunities to catalyze, accelerate, and propel their ventures to make sure that they're actually impacting the communities that they like to serve.
Awesome. Stephen?
Hi, everyone, and thanks for having me here today. And my name is Stephen Forte. I am the co-founder and managing partner of Fresco Capital, and we're based in Silicon Valley. It's a venture capital firm, but we're actually a global VC fund where half of our staff is based in Asia. So we actually represent investments globally. About half of our investments are here in Silicon Valley, and the other half are around the world, which is not normal. So just so you understand that when I give my answers, that we're trying to be a different fund. We're about 10 years old, and we've been trying, partly because of our diverse backgrounds of when we got started. I was actually an expat living in Hong Kong at the time, 10 years ago, and founded it with a Canadian and an American woman. And that is not your normal demographic for a VC fund. So we got started always taking a slightly different approach. And before that, I was an entrepreneur for about 20 years. So never really had a real job. And I did 5 different venture-backed businesses over the course of those 20 years. So I actually understand how you raise venture capital. And somehow that qualified me to become a venture capitalist, but that's the topic for a different path. So happy to express my views and look forward to the rest of the discussion.
Awesome. Gino?
Yeah, Caitlin, number one, thanks for, bringing me to this event and inviting me to be here. So super excited to be here and looking forward to the conversations to be had here. Hello, everyone in the audience. Just to introduce myself, my name is Gino Miller. I'm the co-founder and CEO of Study. It's Study with an H, so SHTUDY, in case anyone has trouble pronouncing or spelling that. But essentially what we do here is help Black, Latinx, and Native American folks find the best job opportunities for themselves, and specifically in tech jobs. So, this kind of started just from, me growing up in the Washington, D.C. area, specifically Prince George's County, Maryland, which is about 10 minutes from D.C. And I had a lot of friends in the area who are amazing people, but just like anybody else, all they wanted to do is create financial opportunity for themselves. And, fortunately, I, fell in love with positive things. They may not have fell in love with things that were as positive. So that sort of sparked that drive for me to start a company like Study, which connects folks coming from underrepresented backgrounds or underserved communities with opportunities that can genuinely change their lives and their families' lives. So, I'm super excited to speak here from a real time perspective. I'm a first person experience. The good thing is we're actually in the middle of our fundraise right now. So I'm learning as I go through this thing. And I think, there's an interesting perspective that I have that I'd love to share with everyone here today. I'm also on a few different diversity and inclusion boards, such as the New Hampshire Workforce Development Committee, as well as the Small Business Development Center here in the Boston area as well. And I'm also on the board of a social venture firm called RBF Fund. So just have a different perspectives in different areas, but I'm super excited for the conversations that come today. So looking forward to it.
Absolutely. Well, thank all of you for joining us. I could not say thank you enough, and I'm probably going to say it about 50,000 more times. So thank you all for lending your expertise to this event. So first, what we want to do is kind of define capital. I know that when we talk about capital, most people's minds immediately go to money, whether it's through equity, loans, grants, or crowdfunding. But social capital also has tremendous value. And oftentimes those two go hand in hand. So Dr. Corprew, can you kick us off by defining social capital and kind of how that plays a part when starting a business?
Caitlin, I think it's a great question. And one thing that we really pride ourselves on at Camelback Ventures is thinking about not only the opportunities to pour financial resources into our fellows, but also being able to provide that community and that coaching aspect. So if we're thinking about social capital, we're thinking about the networks that we have, that we've built over the last 6.5, 7 years, that have the ability to come and coalesce together, congregate together, to pour into our founders. One thing that Gino did not say is that he actually is a Camelback Fellow. He is actually, a 2020 fellow, and so make sure, Gino, that you always say.
Yeah, thanks for the reminder. I don't know how that slipped my mind, but that's the number one way we got started. So just laying that on the table.
We love Gino and all the amazing work that he's done. But you think about this relationship that he and I have and that we've been able to build with our 83 founders. It's not just our ability to pour financial resources, as I said, but it's our ability to bring a cadre of resources, mentors, customers, coaching, just this one-on-one relationships that we have with our founders that allows them to feel like walking into Camelback is this opportunity to feel like they're in a family. And so that's the biggest part. When our founders come in and actually they leave, they talk about, we've gone through other accelerators, but family is the one thing that was really prominent with Camelback Ventures, and it's that continued social capital that we continue to give to them that allows them to accelerate and amplify their ventures. One of the things that we've been able to think about that other accelerators have not is that what happens to our founders post-fellowship, post our accelerator. And many accelerators have not been building on an alumni opportunity. We thought about that, and that was kind of our blue ocean shift, that we're going to pour more opportunities into our alumni. We're not just going to push you out into the sea. We're actually going to moor you for a little while and then actually help you be the rudder. And so we now have a robust network strategy that I'm leading with my good friend Nadia Morris, where we're pouring into the Gino Millos of the world, allowing them to find more capital, more customers, more resources, more mentorship, that social capital that you're talking about.
Absolutely. So Gino, I kind of want you to speak to that. What was the entrepreneurial environment like when you were getting started? How did the Camelback experience kind of help change that landscape?
Yeah, great question. And again, I cannot believe I forgot to mention that Camelback was the first organization that was willing to take a chance on me, because that was, to say the least, life-changing with regards to the way we approached entrepreneurship, and frankly, just from having some sort of peace of mind to understand that, look, it's not entirely your fault as to why progress may not be happening as fast as you would like it to happen. So laying that out there, Family was definitely the biggest advantage. That family feel through joining Camelback was irreplaceable. Just to know somebody had my back and, my team's back was, the most advantageous and really just comforting thing to me at that point in time. To be frank, we had, we say we were founded in 2018, but frankly, we conceptualized this long before that. And to be frank, when we were pursuing it the first time, we had ran short on capital, and we were debating, my co-founder and we were debating possibly shutting the company down. Long story short, he ended up taking the corporate route, which is perfectly fine. I had another co-founder as well who joined us, but Camelback was really just happened to, it felt like fell out the sky at the perfect time for us to be able to, again, take a chance on us and provide us with the initial social capital to get things going. And, fast forward 2.5, 3 years later, it changed everything. It changed the trajectory of the way we saw business and entrepreneurship, and the progress has been stupendous, and we haven't slowed down since. So, I can attest to the fact that just having someone there who understands the journey and is okay to go through that with you makes a world of a difference. And it's the intangibles that I really feel like are the most valuable pieces of that. Like when things get tough, I can shoot Charles an email, or anybody on Camelback's team an email. I could even give them a call, obviously. And, the first thing that they ask me a lot of times is, how are you doing? Like, let's talk about the business a little bit later, but how are you doing? And just having an investor, an advisor, as someone who can approach myself personally like that, I can't say enough great things about it. So that's really the impact that, having, a team who's willing to take a chance from a social impact perspective has had on me. So that's really how it helped me out and, propelled us to where we are today.
Absolutely. I want to kind of switch gears to talk about the capital side of capital, the money stuff. So Stephen, can you discuss the types of financial capital a VC might engage in, seed funding, blended capital, some things like that?
Sure thing. And first, Gino, VCs definitely have like a little checklist of when you forget to mention them, just to let you know. I know Charles is being coy, but he has a check. He keeps track. We all do. Just kidding. Love to discuss, just to kind of set the playing field so we understand the definitions. I know it seems pretty basic, but the terms are actually confusing even to us in the industry deploying the capital. I actually recently had a probably the most important venture capitalist here in Silicon Valley. We did a deal with him recently, and I have a text chain with him back and forth, begging him to write a blog post to identify what I'm about to say. And then he keeps telling me I should write the blog post. It's because it would get all the nomenclature the same. But I tell him if I write it, basically just the people from ACT are gonna read it. If you read it, the entire world will read it. If you write it, the entire world will read it. But he still hasn't done it. I told him I'd write it for him.
We can just use a transcript of what you say here, and that can be the first draft. It's already done.
Perfect. So, and the bad news is this nomenclature changes all the time. But the current state of affairs as of May 2021 is something like this. You have a couple of categories of venture capital, right? So just for the folks that don't understand venture capital, it's a pretty straightforward concept. We go as venture capitals. We are a firm that is set up as a financial institution. We're regulated by the SEC. So you can Google all our SEC credentials that are out there, called Form D. And we pool money, we raise money from other people. They're called limited partners. So you might hear me use that terminology later, or an LP. We raise money from other people, and then we take that money, pool it together, and invest in companies. And then the real question is, at what stage of a company, or what is the capital like? So I'll just quick go through what they are. It's loosely defined like this: pre-seed, and I'll come back and just give it 30 seconds on each one. Pre-seed, then there's seed funding, then is what you would call growth funding. Then there's liquidity, and then there's an exit. And the exit typically is capital, usually by public markets like IPO, things like that. So what do all of these mean? The pre-seed is the early stage capital that Charles was talking about. Typically, it's done at an accelerator. And for the folks that don't know what an accelerator is, it's typically an organization that will then make a simultaneous investment into a number of companies or founders at the same time and put them through a cohort. About 11 years ago, I ran one of the first accelerators in Asia. I was living there as an expat, and it was actually the first in the world that was scoped to a particular domain. It was about mobile development. Almost seems silly now because like accelerators are very scoped, but back in 2010 or so, accelerators were very generic, and there weren't that many of them. And there's also not just accelerators, but this could also include like what's referred to as friends and family or even angel investment, right? So typically a founder will get a bunch of money just to get off the ground, get the product built, get those initial customers, things like that. Then will come the seed round. And a seed round, the reason why I don't like this terminology, because what I just described sounds like a seed round, right? A seed round is a little more established, is usually a little bigger checks. Typically, I've seen seed rounds as large as 5 million. I saw one the other day that was a complete outlier at 60 million, which is a little crazy because the average size is 2 to 3. So 60 is definitely an outlier. But seed round is you're already expected to have a company formed, a business. You may come into an accelerator not incorporated with only a prototype or maybe even an idea, depending on the stage of the accelerator, get some money and build it up and experiment. And the failure rate there is extraordinarily high, but that's part of it's built into the economics. So the seed round, you have a little bit more progress as a company, but you're still very early, right? You're still right. After your seed round, once you've kind of figured out the proverbial things like product market fit, which is a very Silicon Valley term, or what that really means is you figured out your business model, and not like, make widget for $1, sell widget for $2, but more your business model around pricing. What are your market segments? Are you focusing on a market segment of teenage women, right, for video games or things like that? Or are you focusing on, 60-year-old men and, hair loss products or whatever it is? Like that's your market segment, but you've had all that stuff figured out and you've proven it at a really small scale. Now you're attract what's called growth capital. And each of these rounds have different stages within them, right? So growth capital typically starts with what's called a Series A, but then that can go to like the very end of the alphabet. Like companies can raise more and more rounds of seed capital. Some of this has changed over the years, partly due to regulations like Sarbanes-Oxley, which has forced these rounds to get larger and larger. But in essence, you'll see these growth, and they're particularly saying you figured out your business model, now use the venture capital to grow. And then after those growth, and that could also be growth, not just your segments, but then as you go down the alphabet to Series B, C, D, E, F, it could also be like, well, we're now rolling out new product lines, right? So if we were making water bottles, now we're also going to make Camelback. That's actually probably a bad idea since Camelback ventures, but you know what I mean? Like the water backpacks.
Oh, yeah.
That may be called Camelback, some of those brands, which I'm sure has no affiliation with Charles.
You get confused all the time, Stephen. All the time. You work for the water company? No.
Like, no. But you should give out free Camelbacks to like all your founders. That'd be fun to kind of embrace the nomenclature there. But as you go down the line, you may be rolling out different products or going into different geographies, right? So you may, do your global strategy, things like that. Lastly, before your exit, like say, which is an IPO or an M&A, there's like what I call the liquidity stage, which is what you probably read about in the newspaper or the tech crunches of the world, which is when you read about this company taking $100 million, right? Typically, that's not like the companies. You're like, what is that company doing with $100 million? You might ask. Well, typically, maybe only half of that capital is going into the company. The other half is buying out earlier investors, or even some of the employees that are leaving the company or just selling some of their shares. That's usually what's called a blended rate. And when you see the implied valuation, it's worth $3 billion, it's typically not, because that would be, if you bought 10% of the company for $100 million, that company should be worth $1 billion. But typically speaking, when you're putting in $100 million, you're buying only 50% of those shares, at the 10%. And then you're buying the other ones at a discount because they're the common shares that are owned by employees or previous investors, things like that. But that's a nuance that might not be that appropriate. But that's all the stages. And lastly, before I conclude, is just so we know what venture capital is for. I talked about this, is venture capital is for you're already succeeding at something, even at that very early stage, right? You've gotten out of the Starbucks and you're now in the accelerator. And venture capitals really exist to make you do it faster, right? So like you go to an accelerator to accomplish into 3 or 4 months or 6 months or 1 year of your program, what you would accomplish in 2 years, 3 years by yourself. You raise growth capital, a Series A, to attack these markets 3 times faster than you would if you were doing it organically, which is Silicon Valley term for growing through your revenues, through your profit and loss, right? So I'll leave it at that. You are now all experts in venture capital rounds, at least as of May 2021. A year from now, they'll probably change, but you're experts for a year. So I'll leave it at that.
Amazing. Well, I'll put in my 2 weeks at ACT right now. No, I'm just kidding. Could never. Okay, so I want to kind of talk about how the social capital and then the money capital kind of play off of each other. So Dr. Corprew, can we start with you first?
Mm-hmm. Sure. Stephen, thank you for the masterclass. I'm going to need to bring you on to talk to our people. I definitely appreciate that. As we think about social capital at Camelback Ventures, and I love how Stephen really kind of captured, the various nuances and stages, because we're the accelerant at the accelerator stage, and we give that friends and family round. And as Gino can attest, oftentimes we're the first money in, we're the first belief in. And so it's been a number of times that I've called founders where we've been able to say, hey, we're going to be that first money in, for them to say, hey, we've got $7 or $8 or $9, $10 in our account. And this is the money that is actually going to help us. And that's what's happened, where the financial capital that we've been able to give them is one aspect. But when they come to Camelback, as Gino has mentioned, we have been able to give them coaching, capital, curriculum, community, and connection. Right. My job, and I love what I do. I ran our accelerator for 2 years, like you, Stephen, which is a wonderful opportunity. But my bailiwick is being able to go and have conversations with Stephen about Gino, right? About Julio Rivera at Liberate, about Kimberly Gray at UVI, about Norma Paredes at Connecti, all of our great tech firms that are doing amazing things. My job now is to be able to take this relationships that I build with the Stephen Fortes of the world and be able to go and be that wonderful salesman that they may not have, because I know their ventures intimately. We've had those one-on-one conversations. I know their finances. I know their customers because I've gone out and talked to them. I've been able to do that. And so that social capital actually marries with the financial capital that Stephen's going to talk about, because I can go have these conversations for them. And oftentimes what we find, our ventures don't have someone who's advocating for them. Think about this. When you're going to a doctor, right, and you're that family member and your family member can't really speak as eloquently as you like, they need advocates. We teach, right, the Genos of the world how to pitch. I learn as much as I can, because then I can go out and pitch even further. I can get in some of the doors that he might not be able to get into and say, Gino, come along with me. So we've been able to actually marry the social capital aspect with that friends and family round, that early accelerant. And then I can go out and say, hey, Stephen, can you pour some gasoline on this hot venture that we've got to really fire it up?
All right, what kind of... Yeah, go ahead.
That $8, $9, $10 in the account is not an exaggeration, by the way. Like when we came across Camelback, I can attest that I maybe had $100 in my account. Maybe, that's being generous, and long story short, even the investment that came from Camelback, big VC firms, they may say, okay, $40,000 isn't a lot of money. I'll tell you where I come from, that's a lot of money, so just throwing that out there of, the way that they're able to dissect people who have it within them, and then essentially give them the credibility and the resources to move forward and, bring those talents to fruition is priceless. So, that I had $100 in my account at that time, if that, so just laying that out there. So, thanks for that, Charles.
Awesome. Well, what I want to do is switch gears a little bit. So Stephen, I want to turn to you, but first, we can call it out. Stephen is a white guy. So what does he know about what BIPOC entrepreneurs face, right? But one of the things that we have been chatting about, and one of the things that we believe as part of the Amplify Diverse Talent Working Group, is that we don't believe it is only up to the folks who are being oppressed by a system to do all of the work to fix it. So with that, Stephen is a longtime member of ACT, the App Association, and has a vast experience as a global VC. So he's here to help us call out some of those inefficiencies. So with that, Stephen, I want to talk numbers. If we look at just the last year alone, looking at those 2020 numbers, we see that Black and Latinx founders only receive about 2.6% of VC funding, and that's across the board, that's nationally. So why is that? How did we get here? What's the situation?
I mean, it's pretty dismal. And one thing to note before I go into this is, my background actually has a history of political science, dual degree in undergrad before I became a tech geek. And typically when you have, as Charles is showing his approval, typically when you have these problems, the oppressed people bring them up first. And I feel like we have made the shift now where they've gotten everyone's attention, which is great, because now we can try to solve these together as an industry. And so I'm going to try to present both some perspective from over the last 10 years dealing with it, but then at the same time, thinking through what some of these solutions can be. So just getting started off is, Charles said something that's pretty important is I'm gonna do an analogy. I'm not the best person with an analogy, but if I went into a bar and my goal was to talk to 100 people in the bar, I'd have to work pretty hard because I'm just Steve. No one really knows me unless they want to talk about the electoral college and how proportional representation would be better than congressional gerrymandered districts, things like that. Sure. But if Serena Williams walked into that bar or Cristiano Ronaldo walked into that bar, they could talk to 100 people in 100 minutes, right? They can boom, boom, boom because they're famous, right? And that's what a venture capital person is like. We have the money, so everyone wants to talk to us. That is something that I didn't understand when I got into this business. When I wrote my first thesis and raised my first fund, I spent an awful amount of time convincing my investors that I had access to entrepreneurs because I spent 20 years as an entrepreneur. I didn't realize that I would be Serena Williams at the bar or Cristiano Ronaldo at the bar where everyone wanted to chat with me. So because of that, the biggest, and this is getting now to the answer, the biggest thing that we want to do as a venture capitalist is de-risk the investment and filter those investments because we see so many. I mean, companies I probably shouldn't share this with you, but I was speaking at a VC event in Lisbon, Portugal, about 50,000 people. And someone followed me into the men's room pitching me their company, right? That is how, and I'm sure, Charles, you get this as well, right? If you are on a website listed as a venture capitalist, people are looking to talk to you. So then how do we filter the companies down? So that is when you have that many, when you have literally it's about 1,000 companies we look at in a year and we invest in maybe a dozen. How do you distill that down? That's where the problem became, right? And we can talk about the solution, I think, in a new question because it involves actually work that Charles is doing, working with folks that are in the position that I'm in. But we'll get there, so let's not forget that. But I'm going to ignore that for now. Just talk about how we got into this problem. So I'm going to actually go back 10 years. My co-founder was a woman. Most people might have met her. I brought her to some ACT events. And she's very passionate about getting more women founders getting funding, right? Because it's a very similar problem. The numbers are slightly better, but not much. And this was at a time 10 years ago, when only 3% of general partners, that's the decision makers in VC funds. So a general partner would be the level like a C-level position if we were looking at corporate terms. Managing partner, my title is CEO. General partner would be like COO, CFO, things like that, right? And so she was a general partner. Actually, she was a managing partner at the time. So she was the CEO. And she was working hard. And then she said to me one day, she goes, I'm biased to invest in men-led companies. I'm like, what? And she's the one that identified that it wasn't necessarily an unconscious bias. If anything, she has an unconscious bias against men, right? She has consciously stated she wanted to fund more women in venture. But she said it's a pedigree. She goes, the way you filter down from 1,000 to 10 or 12 is you look at the pattern and you look at what the other VCs are investing in. The biggest de-risk could be that another VC is investing in that same company, right? So my advice to entrepreneurs is always, you want to get your company founded, find someone to write that first check for you, right? Because then that's a signal, and then make that first check work on your behalf. Exactly what Charles is doing. So we have this pedigree that comes through these filters because, as I said, if you have to do 100 for every, you're rejecting 100 for everyone, and it typically looks the same. It's they went to Harvard, they dropped out of Harvard, they went to Stanford Business School. Unfortunately, this pedigree, if you could afford to go to these places, and then if you could afford to drop out, typically you come from a wealthy family, and typically those wealthy families in this country are not people of color, people that look more like me, not my fellow panelists, right? I went to state school, just to let you know. So how do we fix this problem? Just a quick preview is we see typically that are put in front of us de-risk companies that follow a particular pattern. It is not necessarily a subconscious bias against people of color and all these other groups, while that does exist. So I think that the solution to this is twofold, which we can explore later. I think the bigger one is increasing the access to the decision makers at the VCs. So the work that Charles is doing, right? Increasing that access. And then of course, just getting more diverse people in decision making as well, because that will remove the unconscious bias. I really do think it's about, the problem could probably be about 60-40, like 60% of the problem is the access and maybe 40% is not enough diverse people in the decision making, because again, go back to my partner Allison, right? Like she fell into that trap of being of looking at the patterns, of looking at the the pedigree.
Absolutely. Dr. Corprew, I want to give you an opportunity to answer that question, and Gino as well, if you had anything you'd like to add.
I do, and Stephen, thank you for that. One of the things that I think every organization in this ecosystem has to think about is how they're doing the internal work. For us, is how are they funding? And so Stephen talks about the potential bias that was happening within his organization and how to begin to mitigate that or rectify that. Just because Camelback is a BIPOC-led organization, we still had to do our own internal work to look at who we were funding. We talk about women and BIPOC founders, but in those realms, who were we funding? And so we had to think about, were we funding? How many Latinx? How many AAPI, Asian Pacific Islanders, were we funding? On down the intersectional spectrum. And so we really had to look at our internal resolve and resources and who we were internally as an organization to make sure that we're actually holding up to our mission. And that takes a lot of work. And I think as you talk about this, Stephen, is that even people who look like Gino and myself, or who are in decision-making roles, still have to do that internal work to ensure that they're not still having those, oftentimes white supremacy oppressed mindsets about these are the prototypes who we should be funding, because that's what's been, because that's what's been stereotyped or said, this is what's good, right? As you keep using the term demystifying or de-risking, right, the fund. And so we had to do that work as well. And one of the things that we've done also is that we've thought about this from a philanthropic side. My good friend and colleague Elizabeth Bates, with her Capital Collaborative. And so we thought about how are we going to promote up the chain to think about who's funding our founders. And oftentimes these are white-led, white-facing institutions, right, who are thinking about the work, or maybe not even thought about the work, but now being pushed to do the work and are saying, well, how do we do it? And as a larger organization, Camelback said, we can do this work. And then Elizabeth Bates, who is our senior director of our Capital Collaborative, has now developed a wonderful curriculum and has worked with numerous philanthropic organizations across the country to think about how they can be more equitable in their funding. And who did we start with? We didn't start with CEOs. We didn't start with executive directors. We started with the players, right? Those program officers, those upper level, but still having some that are down in the everyday minutia of funding, to get them to think about, wow, let me look at my own personal portfolio of funding, and it's not representative. What am I doing? And so when they began to see that, they begin to say, okay, how do we clamor for change at the larger decision-making levels, at the board level, at the executive director level? Because once you build this fire from your program officers, right, that's when you begin to see it. Now, and then I always talk about this top down. You get CEOs, executive directors to begin to think about their own internal work, but that's what has to happen. Every organization who does this work, whether they're BIPOC-led, white-facing, whatever, has to do the internal work to think about how they're going to unearth and deconstruct their biases that they've had for long periods of time.
Absolutely.
Yeah, and I would just like to add to what Stephen and Charles said there. And I think Stephen brought up a good point. Stephen, you brought up a good point by mentioning that a lot of times, like, unconscious bias very much does exist. And but at the same time, what needs to change isn't, put it like this, like, it's at a certain point, things become conditioned as the way people's minds work when they look at certain investments, or essentially what happened to work for them for the last investment, right? And just from a business model perspective, a lot of times it makes sense to follow the same criteria that happens to show the best results based on what's already been tried. And then you have, folks like Camelback, and this is again why I'm so thankful for companies like Camelback, because they took the unpopular approach of, a model that may be a little bit more risky, of a model that, may require a different lens to find the entrepreneurs who would be the best fit for that type of model, if that makes sense. So they may not be, I guess I don't know, what the recent fundraise was, but it may not be necessarily, someone who's funding a Series A or a Series B or something like that. But what they do is they do a really, really good job at looking for the characteristics in founders and diagnosing those characteristics, and then helping, again, bring those characteristics out, bring them to surface, and then helping the individual become a better person, which results in a better company, right? And that's really hard to do. Now, don't get me wrong. It's not like you can just show up and, just have any type of business. You have to be putting your own work in. You have to, really show that you understand what's going on. But with that said, they fully get the fact that everything may not be fully ironed out just yet. So, I appreciate, again, where we are right now. I feel very confident with where we are as a country. Again, the fact that we're even having conversations like this and people are excited to have conversations like this, I think is starting to bring to surface that models like that, more models like that should be out here. And we're starting to see success in that area as well, from prioritizing social impact and prioritizing, who is the founder, as opposed to, everything being exclusively based on traction or, whatever the past criteria, or not even past criteria, but other VC criteria may be. And even VC firms at this point. And again, Stephen, it's amazing that you're here on this conversation speaking about these things, because it's very much, I think, these conversations are going to help this become the new norm, right? And that's exactly where we should be. So that's what I'm most excited about is, seeing that shift happen and helping people. People are finally realizing that success, you could be a social impact business and still make money at the same time, So that's refreshing to have those types of conversations nowadays.
Caitlin, I just wanted to say something. A good friend of mine, Seth Levine, who's a wonderful partner of Camelback, is coming out with a new book called The New Builders. And it is a wonderful opportunity. It's, as he and I, have this wonderful relationship, built relationship. I kind of joke him a little bit, because it's kind of like the Jerry Maguire manifesto. It's, Seth, white man, but The New Builders is really about thinking about equity in funding, and how there needs to be a new shift in VC and capital. So, a wonderful book that's coming out. I just want to promote this opportunity to read something that is kind of this manifesto, this new manifesto. I just always remember Jerry Maguire. He's like, it was just a mission statement. But here's this opportunity for shift that can be a cataclysmic shift in the landscape to really think about, right, the success of BIPOC and women founders. And I know that's going to get to your next question, but the success and thinking about funding when it's outside of the prototypical, right, entrepreneur.
Absolutely. And like you said, segued perfectly into my next question. So when we look at lending, we see that BIPOC entrepreneurs face difficulty at financial institutions. When you compare the approval rate of white entrepreneurs to the approval rate of BIPOC entrepreneurs, you see that white folks are approved at a rate about 2 times more than Black and brown folks. We saw another dangerous version of this, during the COVID-19 pandemic, when Black business owners were denied PPP loans at 2 times the rate of their white counterparts. Outside of the extremely obvious problematic nature of this practice, what dangers do we as a society face when this is the economic reality for millions of Americans? Dr. Charles, we can start with you.
I think it's another great question. Really thought out. I think about last year, and with the onset of COVID, our staff came together and really began to think about how do we want to ensure that our founders don't fall or fail. And so because we began looking back at 2007, 2008, and 2009 with 40% of BIPOC businesses failing and thinking that those numbers were actually going to be the same. We're almost a year later. None of our founders, right? All of our doors are still open. None of our founders said, hey, Camelback, because of COVID, we've got to close our doors. One of the things, if we go back to social capital, right, and the fiscal capital, we were able to deploy about $500,000 last year, which in VC world is not a whole lot of money. But those lifelines that we were able to give during this period of time, because of partners like Vela, like Gates, like Walton, who said we want to continue to invest, we were able to deploy those funds. But our founders didn't take those funds and say, we were going to play with those. They took those funds to continue their success. And so they were able to amplify their ventures, particularly our education ventures, who saw a robust uptick in revenue and customer base because, as you know, if you have kids, in the audience, what it's been like to educate your students over the last 12 months. It has been simply chaotic. And so many of our founders have been able to actually test new products, build or expand on their existing products to help more people. And because of that, because of the opportunities that we've been able to see, because of their ability to amplify and impact more of their customers, we have more money coming in to continue those investments to them. And so when we think about this, if we're not investing into BIPOC communities, right, particularly during periods of times of stress, we're losing out on creativity, right? I think about this, if we weren't able to invest in Gino and his ability to marry tech graduates and tech firms, particularly during this period of time, more tech graduates of color are coming out of schools now, right? And the ability for firms to say, hey, we've got a conduit with that ability. And then, hey, we're the first money in. We invested in something that actually has the ability to 10x, right, this opportunity through his platform. What a wonderful thing. If we're not investing in women and BIPOC founders, we're not being inclusive and we're not thinking about this vast level of creativity that impacts all of us. We can't just think about one side of the fence. We have to think about opening that fence up to everybody.
Absolutely. Gino or Stephen, do you have anything you'd like to add?
I will add real briefly I agree with what Charles said, and I'd actually like to extend it a little further is when you make a venture capital investment, and there's just so much VC money out there now, thanks to the Federal Reserve and the zero interest rate policy, a lot of money goes into this asset class. And VCs are always looking for the diamonds in the rough. They're always looking for the competitive advantage. They're always looking. And if they skip over that, the companies, that market segment, and then that obviously having, geographic and demographic segment, if they skip over any of those, not only are they missing out, but also is a missed opportunity long-term that people don't think about it. And this is the piece I wanted to kind of focus on is our best investment to date was 10 years ago in a company in Estonia, and it went from nothing to a multi-billion-dollar exit. So you can imagine Estonia is not, on par with the rest of the European Union in its in its income. But now what's happened is there were like 400 and some odd employees. They all did okay. So, even the lowest level employee got a check on that deal. But now they have a risk tolerance that's much higher to go do another venture themselves, to join another high risk startup, to go do something else, right? Besides the economic cushion, but precisely because of that economic cushion. So what I want to see is more Genos getting the funding. But I'm thinking 10 years from now, when he is made all the money, what is he going to do? Probably go start his own VC fund. That's what founders seem to do these days. But more importantly, he's going to either go start another startup or invest in a startup or do something like that. And the only way that we can start getting that and then having that ladder is to start funding those companies today, right? So it is a long-term solution. So that is the big risk. Because again, if you're going to deny loans, if you're going to deny capital, that cycle can't start, right? So the faster we start that cycle, the faster we'll start getting towards, parity.
Absolutely.
Yeah, and just real quickly, I'd like to bring that home by saying, and at the end of the day, people invest to make more money on their investment, right? Like that's the bottom line and the reason as to why people invest. And I feel like, again, going back to my point I made a little bit earlier, is that it's okay to want to make money. Now, I think we're at a position where VCs are finally starting to recognize and accept the fact that a criteria different from what they've been used to can also make them money. And investing in POC founders, I personally feel like, I don't have the stats off the top of my head, but I feel there's a strong correlation between the companies who prioritize, again, social impact, but also have their I's dotted and their T's crossed from a business perspective, and the ability at which they're able to scale and bring in larger revenue versus, a company who may not necessarily prioritize social impact as much, because these are real problems. I was actually speaking to, a really good friend of mine who's an investor. He exited his company for a few $100 million, and he's a Black man, and we were having, really honest discussion with each other. And he told me I won't say the board that he was on, but he was on a very reputable board that prioritized diversity, equity, and inclusion, but they're having a change of management. So the direction of the organization, he's not necessarily in alignment with. But long story short, he said he was at a meeting and he sort of got backlash because he said a lot of the largest Fortune 100 companies don't solve real problems, or a lot of the most recent, well, I guess you could say startups of the recent decade don't solve real problems. And I've never heard that before. And so I'm like, well, Airbnb, they help people, find homes, or, they help people, rent out places when they go on vacation. But he's like, is that a real problem though? And I was like, that's a really good point. Because he brought up the fact of, who are the ones, and for, again, I don't want to put companies on blast, but Uber, just off the top of my head, is another example. Who are the ones driving the Uber cars? Who are the ones giving people rides? Who are the ones excited about the opportunity to make another $10, $15, $20 an hour versus the ones who are more excited that they now have more time versus calling a taxi, right? So just laying that out there. But when social impact is there, i.e. employment, or i.e. focusing on sustainable economies. I don't know, just thinking of off the top of my head here, these are the real problems that will always be there. When I'm speaking to investors, I tell them a lot of times, worst case, they ask, the famous question, what's your plan for exit, right? And I'll tell them, worst case scenario, we'll exit for, in 2-3 years, we'll exit for $100 million just off of the simple fact that we're solving a real problem. We have candidates of color here. Worst case scenario, we build a database full of 100,000 candidates, do nothing with them, and we can still sell that data, right? And, just opening that lens, I think, is huge to, breaking barriers in the VC world and the social impact world at the same time. So I think those both were really, really good points.
Absolutely. I know, Stephen, you mentioned you might have something to say here.
Yeah, I just want to extend on that just real briefly. As some of you may know, as 3 years ago, we partnered with the Vatican, a very unlikely partner for Silicon Valley venture capital, to build a social impact accelerator inside the Vatican, which we did about 3 summers ago. And what I learned during that process was that, there's estimates, depending how you read it, from Price Waterhouse or, from the UN, that social impact problems are a $30 trillion business opportunity, right? So anyone who thinks you can't make lots of money in social impact and do good at the same time has got it wrong. And I've learned from that process that it's you can actually have both, and that's where the market is starting to head. Like when we started this project with the Vatican a number of years ago, no one really took us seriously, and now I feel like everyone is starting to. And ultimately, as a kind of concluding point on that, is the only we had 10 companies that we're bringing through this program, and I had to do a lot of negotiation with the Vatican, which is a topic of another conversation because that was interesting. But the only real thing they said to me said, Steve, just don't bring like 10 companies with, like from Silicon Valley, like have us represent the world, right? They said, you do that the right way, right? But just have it be global in its representation, which is exactly what we did. So we had amazing diversity numbers, of course, by doing it that way. So, and the results were spectacular. So it's out there.
Awesome. Okay, we're headed to the last question, folks. So I know that we've mentioned there's going to be a part 2 of this panel where we're more solution oriented, but the goal here was to call out imperfections and inefficiencies. So I want to use this opportunity to allow the panelists to amplify any additional issues that we might have glossed over or might have totally missed. We are the hosts of this event, but we understand that our understanding of complex issues like this can always be improved with more input and guidance from people who definitely know better than us. So we want to help facilitate that dialogue. If you have nothing to add for this, you can just go ahead and say what you're excited about in the lending space coming up. But Dr. Charles Corporal will go ahead and start with you first. Oh, sorry, you're on mute.
That's what I was trying to figure it out. First, I want to give a shout out to our senior marketing director, who is amazing, Tanya Dahl, for joining us today. She is a juggernaut when it comes to marketing and PR for our organization and has an extensive background in marketing PR, has worked across the country and doing amazing things. So thank you. One of the things that she reminded me as she does so eloquently is to make sure we'd like for everybody to follow Camelback Ventures on all of our social media. So I'm gonna do a little PR. We're actually in the midst of our Search on the Line, which is our recruitment to actually fund more Genos of the world. And so we're actually excited about that work. We actually shifted our accelerator this year to 2 tracks, Conscious Tech, and Education. So have 2 wonderful people who are leading that work, as well as the work of my good friend and colleague, Kelly Salney, which is our Guardian Summit, where we bring thought leaders from across the country to really think through some of the questions that we're answering today. How do we bring more capital into BIPOC and women-led companies and really think about how do we amplify those ventures? So we're really, really excited about that work and want to make sure if you want to know more about Camelback Ventures, please visit our website at camelbackventures.org to learn about our 83 founders and the work that we're doing. And so any support that that you would like to give, we were always looking for mentors for our founders, the opportunity to pour into them. That is a wonderful, wonderful thing. And I think if we're thinking about solutions, I would like everybody to think about how do the things in their lives impact them, and how could investing in BIPOC and women-led founders help them solve some of the problems that they are experiencing. As I said, that genius is here. Everyone has genius, but the opportunity, as we've been talking about, has not always been there. And so we want to make sure, at least at Camelback Ventures, that we're providing those opportunities for BIPOC and women-led organizations.
Absolutely. Thank you so much. Stephen, you want to go ahead and give your final thoughts, parting words.
Yes, on things that we missed, it's probably out of scope, but I think shining a light on the algorithms in AI and credit and hiring, which we can really drill into. And the reason why I want to bring that up is I've actually flagged it to ACP as well, as I feel like some of the solutions is just throwing the baby out with the bathwater. So I do think I do think that there's ways to address the problems in those two particular categories, credit and job hiring. But I do want to end on an optimistic note. I do feel, thinking of part two is because then this is where you can dive into some of the solutions is 10 plus years ago when I got started as a venture capitalist, I couldn't, even if I made it my whole strategy, I couldn't find the people of color to go invest in because folks like Charles didn't exist, right? Those organizations didn't, or they weren't being heard. So now that there's that access is there, I find that is a great trend. In addition, what I learned at my work at the Vatican is the younger generation, particularly Gen Z. For those of you who know me, I make fun of millennials a lot, particularly Caitlin on TikTok and things like that, but that's a different story. But the Gen Z, which is now the coming of age, and we're starting to put money into Gen Zs, they care about these issues greatly. And then on the other side, if you remember, I mentioned the limited partners. Those are the people who put money, the people in the institutions that put the money into venture capital. They care greatly about this because a little unknown fact, a lot of them are either sovereign wealth funds or pension funds. So they have public mandates to care about this. If they truly don't, they're forced to by statute, or they're wealthy family offices that have figured out that not only is it the right thing to do, but it's actually good for business, right? So the sources of funding are concerned about this issue, and the actual the recipient of that funding is conscious of the issue, which then forces my entire industry to be concerned about the issue. So I actually have some optimism. However, it's still going to take a lot of work and it's still going to take time. So, that's something we can drill into in the future. But I am cautiously optimistic. I just want to temper that optimism that it's, funds, this is a big thing. Funds are 10-year entities, usually with a 2-year extension, right? So I only get feedback after 12 years, which sucks, to be honest. So solving problems in venture takes a decade, just throwing that out there. So, but you got to start now, right? It's not an excuse not to get started.
Absolutely. And Gino?
Yeah, sure thing. So yeah, number one, I just want to show my appreciation for being here. I think this was an amazing discussion. We have, I would like to shout out the fact that we have a career fair coming up for a study. I'll actually drop the link here in the chat in case anyone, I think I actually sent it the wrong one. Here it is here. So in case anyone wants to check out the landing page or see what we have going on, it's coming up on June 30th. So I'm going to be a super exciting event. If you or anyone may be just looking for additional ways to get in front of employers in tech who would be interested in possibly hiring them or things of that sort, anyone and everyone is welcome. So I highly, highly encourage you to be there. We'll have some pretty cool companies there. We haven't finalized our list yet, but when that's done, we'll definitely make that known. So I highly encourage people to come there, or even if you don't want to attend a career fair, but are looking forward to keeping additional opportunities open moving forward, I invite you to come sign up for study as well. We genuinely do want to help people. This is really what gives us joy and helps me get out of bed every morning. I can honestly say that because some days it's hard, but in the back of my mind, it's that little voice saying, okay, if you sleep an extra hour, then there's a candidate somewhere out there in the atmosphere that may not get a job today. Right. So, just laying that out there. But yeah, we really do like to help folks. And thanks, Charles, for dropping the website too. So, any and everyone is welcome. And thanks again for being in attendance, and definitely go check out Camelback Ventures and what they have going on too. So that's my 2 cents for now.
Awesome. Well, I want to thank everyone again for joining us for this discussion. Thank you to all of our panelists. And if there were any questions in the Q&A that we were not able to answer, which was all of them, we'll go ahead and follow up via email to make sure that y'all get that information. Thank you all so much for joining, and we will see you in part 2.
Thank you.